Thank you for joining us on our review of the first quarter 2024. My name is Jared Menstrik. I am the Senior Portfolio Administrator here at Austin Wealth Management. For this call and for future calls, I'm going to be taking over hosting duties from Kevin Smith. I work in the investment department here with Matt and Kevin at Austin Wealth Management. And of course, we're also joined by Matt Pierce, our Senior Portfolio Manager. And I'm going to go ahead and kick it over to Matt to review what happened in stock markets and bond markets in Q1.
Great, thanks, Jared, and thanks for pitching in here on hosting duties. All right, so our normal fare here of just kind of taking a brief tour of the world in terms of stock market performance to start the year, and broadly speaking, it's been a pretty strong start to the year on the heels of a really good 2023 as well. We see the S&P 500 up just shy of 10% through yesterday. We're recording this on April 2nd, so this is through April 1st. So first quarter plus a day for everyone here. So we're up about 10% year to date on the S&P 500. Looking internationally, the EFA, which again, just as a reminder, is an index tracking the developed international markets. So again, Western Europe, Japan, Australia, etc., is up about 4% for the year. And then emerging markets continuing to be the laggard, up about 1.79% to start the year. But as you can see, they both had a little bit rockier start to begin the year, mostly on the heels of continued weakness in China. EM benchmark was down about 6% early in the year. And it's since recovered. We've seen a pretty strong reversal in Chinese equities on the backs of some maybe not good, but less bad economic data out of Japan. So potentially some signs of the global economy starting to turn the corner a little bit here. And the strength in equities maybe broadening out a little bit beyond the Magnificent Seven here to start the year. Switching gears here to kind of a more granular, detailed look at the U.S. market. So again, the S&P 500 is up just shy of 10% for the year. You can see the NASDAQ composites up about 9.23%. And again, have used that historically to show the disproportionate returns that we were seeing from some of those largest constituents within the market. But you can see, a little bit more balanced again this year. Maybe a little bit of early indications of some broadening in the rally. You can see the equally weighted S&P 500, which again mitigates the size factor or the extreme concentration in some of those largest names by equally weighting all the components, is up just shy of 7%. So, pretty strong start to the year. And then looking at small caps, still lagging a bit here. The Russell 2000's up 3.75%, just shy of 4%, and small cap value represented by the Russell 2000 value is up just over 1%. But again, both of those had a pretty rocky start to the year and have since recovered those losses and have been performing a little bit better on the heels of, again, broader or global data looking a little bit stronger, but also, as we'll see, the U.S. economy may be starting to improve a little bit as well, and perhaps this much discussed soft landing or no landing is actually materializing and coming to pass here. All right, switching gears to the bond market. So a lot of, at the end of the day, kind of nothingness to start the year in the bond market, not too dissimilar from what we saw last year, a volatile year, but effectively went, kind of more or less nowhere when we looked at the 10-year treasury. We pretty much started and ended at the same place in 2023. And, that's kind of much the case now. We've seen a little bit of a rally or a little bit of a move higher in yields from the lows towards the end of last year. Particularly as we've seen the anticipated rate cuts be reduced the further we've gotten into the year, again on the heels of kind of some of the stronger than expected data, inflation remaining a bit sticky, as we'll discuss as well. So we've seen rates rally a little bit off the lows of last year, but effectively more or less kind of flat on the year for the aggregate bond index as well as the treasury market, and then corporates continue to be strong and kind of outperforming within the fixed income market. Looking again at just the rate picture here, so the Fed has remained steady since really kind of late summer of last year at this 5.25 to 5.5 range for Fed funds rates. And the market's still trying to determine when and if the reversal in interest rates is going to come. So we continue to see a lot of volatility further out the curve, but really has not moved significantly over the course of the last year plus. So you can see the two-year rates at about 4.6%. So again, more or less the market still anticipating, call it 75 basis points or so worth of cuts, or 0.75% worth of cuts throughout the course of the year here, most likely. And then the 10-year Treasury is sitting at about 4.2% as we stand currently. And again, you can see off the lows that we hit kind of towards the end part of last year, early part of this year, where the Fed was starting to signal rate cuts, and the market was anticipating significantly more rate cuts than have materialized or may materialize throughout the year. The markets coming into the year were anticipating a high probability of a cut in March, and now it's looking like maybe late summer probably for the first cut, and the Fed's still signaling somewhere on the order of 325 basis points or 3/4 point cuts throughout the course of the year. All right, so looking at corporate bonds here again in a little bit more detail. So the reason for kind of that continued outperformance on the corporate side is that while rates have remained volatile, spreads have remained very benign and have been trending lower over the course of the last, call it year and change. Again, those spreads indicate the additional compensation that you receive for the higher risk associated with corporate bonds, where there is the risk of default, versus in government bonds where there is no default risk. So you can see on investment grade corporate bonds, so this would be higher quality corporate bonds, those spreads are well below kind of the 25 year average of 1.5% at 0.94%. And then even on the high yield side, continue to be pretty muted there as well, with high yield spreads coming in at about 3% over Treasury yields. And that's well below the 5.35 average, again, over the last 25 years or so. So credit markets continue to be, signaling all clear. Again, that more often than not can be a counter indicator. Once those spreads get really tight, more often than not, you do see a significant reversal as investors kind of get a little bit complacent, but as of yet, no signs of concerns within credit markets. And then the last thing here, kind of on the fixed income picture, is again this idea that yield curves still remain inverted, and again, this has been that classic early recession indicator. We're now at, I think, one of the longest, if not the longest, sustained inversions. And at the kind of trough, we were at one of the most extreme levels of inversion as well. Currently looking at the difference between 10-year Treasuries and 2-year Treasuries, where, again, 10-year Treasuries are, call it 40 basis points or 0.4% below where 2-year Treasury rates are. Have heard some interesting theories that maybe kind of briefly opine on. One kind of interesting element is the lack of issuance that we saw last year on longer dated Treasuries. So Treasury opted to do much of the large amount of issuance that we saw within the Treasury market at the shorter end of the curve, so more Treasury bill related issuance versus the longer end. So that probably helped remove some pressure that ordinarily would have been there at the long end of the curve. And if you look at other areas of the market that tend to track in line with 10-year Treasuries, like, for example, agency mortgage-backed securities. So these are mortgage securities backed by government agencies, so really implicit government guarantees in the case of like Fannie Mae, for example. The spread between Treasuries and mortgage-backed securities tends to be around 0.75%, give or take, and we're currently at about a 1.5% spread there. So if you kind of normalize that difference between the two, the 10-year would essentially be maybe trading 75 basis points higher in which case we actually wouldn't be inverted, currently, if those spreads kind of remain consistent. So potentially some exogenous or extraneous factors explaining why the yield curve remains inverted, when in fact the signal may be kind of muted by some of those outstanding factors. Again, the lack of issuance and things of that nature, while the demand for them has more or less remained the same, with primarily insurance companies and banks tend to be a lot of the buyers of those, and those have not stopped really by any means, but the supply has been curtailed a bit over the last year. All right, with that, I think that covers the market portion here.
Great. Thanks for that, Matt. Let's zoom out a little bit from the financial markets and take a look at that current economic backdrop and any changes we've seen in Q1.
Yeah, sounds good. So, as I mentioned before, wanted to touch on the inflation piece here. It does continue to be perhaps a little puzzling that the Fed is continuing to stand fast on rate cuts and anticipation of rate cuts throughout the year, when by pretty much all measures, inflation has still yet to get to their 2% target. I mean, I guess the idea would be that they have confidence that it will, eventually kind of revert to those levels, but we are still, particularly on headline CPI, which is, kind of the main number that most folks look at, still above 3% on headline consumer price index, and, kind of starting to show some signs of bottoming and maybe picking back up. I think one important kind of consideration or note as we look ahead for the rest of the year, as we talked about prior, when we see these headline inflation numbers, these are again rates of change of the index. So when inflation goes from 9% year on year to 3% year on year, inflation is still going up. It's just going up at a slower pace. And again, this chart on the bottom that we've showed before in terms of the actual consumer price index level, continuing to march higher, really shows that that difference there. But because it is a rate of change figure, what you see is really a large part of it is driven by what are known as base effects, but essentially what you're comparing against. So, the year ahead is being compared to the year prior. So in 2023, for example, we were being compared against the 40-year high prints that we were seeing throughout the course of 2022. So the base effects, kind of argued for, a natural deceleration in the rate of change of inflation. But now going forward into 2024, we're comparing against those more benign numbers that we saw in 2023. So the base effects actually start to soften a bit. And so if we kind of just remain where we're at, we should see kind of this 3% level likely persist throughout much of 2024. But then, looking ahead, if we are starting to see perhaps a bottoming in the global economy, we're starting to see commodity prices kind of pick up off the bottom and start to reaccelerate a little bit, that could actually potentially add a little bit further fuel to the fire. We could actually see inflation maybe reaccelerate a little bit throughout the course of 2024. Again, likely not to anywhere near the levels we saw in 2022, but certainly not the 2% that the Fed has maintained is their long-term target. The chart on the screen here is just showing the year-to-date change in oil prices, so up about 18.5%. Again, coming off the lows here, but if that were to continue, then rising oil prices would start to likely filter into higher CPI prices potentially as we progress throughout 2024. On the kind of broader economic growth side, we continue to see strong GDP growth. Had a surprisingly strong number again that we mentioned in Q4. We don't have any Q2 data as of yet. Like, we won't have the first reads on that for a couple weeks here. So still operating off of the Q4 data, but very strong Q4. Did see a little bit of a slowdown in some of the data that kind of builds into these numbers like retail sales and others in kind of January and February of this year, but that's also started to reaccelerate here in March. So likely another relatively strong quarter coming up for Q1 GDP, particularly in the latter half of Q1, and inflation numbers still remain incredibly low at 3.9%. So again, this much predicted and feared recession continues to remain unmaterialized, and still no signs from the kind of headline numbers. As we talked about before, these are the more kind of rear view mirror looking numbers, but the forward indicators, as I kind of alluded to in the market commentary, have also started to pick up a little bit. So we've talked about these ISM surveys that are generally have done a good job of serving as a little bit of a forward look as to growth prospects. So this is surveying corporations, on various components as to where they think things are headed in the economy, be it from an employment side or increasing inventories, all the various components kind of going into a business, and then it's divided out into the manufacturing economy and the services economy. So as we talked about before, the services economy has still remained relatively strong. Again, just to reiterate, readings above 50 on these surveys indicate acceleration, and readings below 50 indicate deceleration in the various kind of components or surveys here. So again, the services component has remained in expansion throughout 2022 and 2023. We've seen a significant deceleration, but we have still seen positive numbers on that. But the manufacturing side had a very rough 2023, corresponding with global growth slowing significantly, U.S. growth decelerating as well, but still remaining in expansionary territory. But again, we're starting to see some signs that maybe that's bottoming and turning the other corner now. We saw kind of a reading above 50 for the most recent ISM survey, so starting to show some potential expansion within the manufacturing economy. And then just wanted to revisit this slide that we highlighted last quarter, as well as another slide. We talked about last year as a potential source or suspect as to maybe why a recession actually didn't materialize in 2023 was the significant uptick in government spending, particularly for an economy that was still in an expansionary or growth mode. Tend to see those accelerations in spending into a slowdown to kind of ameliorate the effects of a downturn or a recession. But we actually saw an acceleration while the economy was still, at full employment and growing. And we talked about, for the economy to kind of remain strong, we would either need to see that spending continue at the same or greater pace, and or the economy the private sector start to pick up a little bit. So we're seeing those potential indicators on the manufacturing side, and globally, where a lot of countries are starting to bottom and turn the corner a little bit. So we may be seeing that pick up there, and all indications seem that the spending may continue at the same pace as well. So all that to say, growth could and may very likely remain robust throughout 2024 as well, potentially. And kind of the last chart wanted to highlight here is kind of within the mix of these unresolved questions around the state of the economy, inflation, etc., is another kind of puzzling divergence here. We've talked about, on the one hand, the yield curve has continued to have this recessionary indicator, but credit spreads have remained super tight. GDP growth has remained strong, employment's remained strong, etc. This is another interesting kind of divergence from the historical analog, at least here. So the chart on the screen here is gold price in US dollars and 10-year real treasury rates. So this is the interest rate on inflation-protected bonds. So this would be the real after inflation interest rate that you would receive for those bonds. So the orange line here is that real rate. And you can see we've had a steady, not really steady, a huge move higher from the negative real rates that you were receiving from TIPS in the wake of COVID and the extraordinary measures from the Fed and fiscal policy. And we've now moved in short order to essentially 25-year highs or just off 25-year highs in those real rates at about 2%. Historically, you tend to see gold moves in the inverse to that. The higher the real rate you can achieve from those treasury bonds, the less need people may feel for gold within their portfolio as kind of an inflation hedge. But we're seeing a very interesting divergence here where those real rates remain elevated at 2%, and we're seeing gold breaking out and continuing to set new all-time highs throughout the course of this year. So don't necessarily have an answer, or won't maybe posit a hypothesis for this call, but another interesting divergence within kind of this mix of economic data. I guess the short version would be that could be interrelated with that last chart of government spending, as potentially other countries are maybe having concerns around some of the fiscal imbalances within the economy, and the price in gold has really been driven by external foreign demand. What we've seen thus far in terms of gold flows into and out of gold. So it's certainly something to stay abreast of and keep paying attention to here potentially. All right, with that, I'll turn it back to you, Jared, for some closing remarks.
Excellent. Thanks, Matt. Always appreciate your commentary. That does it for our Q1 review. Again, thanks for joining us, everyone. For future calls going forward, we do want to open it up for any questions or topics that you would like us to explore. We of course, want to make sure that we're covering relevant information for you. So if you do have questions about the market or about the economy, or just any topics that you're interested in that you'd like us to explore, then feel free to reach out to us. You can reach us at trading@austinwealthmgmt.com, or you can reach out to Matt or I directly if you have any questions, and we will try to cover as much as we can in the next call. And with that, we will see you in July for the Q2 review.
Thanks, everyone.
Thanks.
This is really for educational purposes only. If you have questions about your specific situation, please consult a professional. Thank you.